everyone, and welcome to another episode of the Adjusted for Risk podcast here from the shores of Lake Tahoe. So it currently is and has been a very tough macro backdrop for investors, really since the last 3 months of 2021. The Federal Reserve is aggressively tightening policies with the steepest interest rate hike since 2000. Which are likely to result in a change in the 40-year trend that we've been experiencing of downward sloping yields and interest rates, all while inflation is at 40-year highs and inflation looks to remain stubborn for the near term. So because of this macro backdrop, the recession rhetoric really has gone from a simmer to a boil recently, because the Fed was slow to remove its accommodative policies. It is now playing catch up and forced to be very aggressive in its policies to try and slow demand to bring demand in line with supply. And as we know, the Fed cannot fix supply issues, cannot fix the supply chain issues. So fixing the supply-demand imbalance will really go a long ways to taming inflation. And in doing so, the Fed is certain to slow economic growth in 2022, and some believe potentially tilt the economy into a recession. Yeah, and the Fed is also signaling how difficult of a task of a soft landing is. And it may tolerate a mild recession to bring inflation down with its softish landing commentary, rather than talking about a soft landing. It's gone from talking about a soft landing to a softish landing, which provides some investor participants some questions on whether the Fed really, is okay with pushing the economy into a shallow recession in order to tame inflation. There's no arguing that some economic data started to roll over. For example, you have global PMIs. They've rolled over recently and started to fall near that 50 break even level. China's PMI is well below 50, and as is the aggregate emerging markets PMI, which indicates a contraction. More broadly, the world PMI currently sits at roughly around 52, which is really close to that 50 breakpoint level. While it's still above 50, the US PMI has been falling since peaking in June of 2021. So you have PMIs that measure manufacturing and services activities starting to roll over. And then you have the jobs report. So weekly jobless claims, while still very low, have started to inch back up in numbers over the past 4 weeks. As some companies have started to announce layoffs or halt hiring, such as Meta or Facebook. However, the labor market still remains very strong, as there remains still about 6 million more job openings than the number of unemployed. So now, we can talk about earnings. So economic data, there's some softness in economic data that might give people concerns. And then, earnings this quarter, it's solid. A lot of companies beat expectations. Earnings growth year over year is, well, it's under double digits. It's better than expected, which was calling a forecast for 6%. But this week or last week, there was a lot of surprises on the retail front, on the retailers. So there was a lot of talk from those about those earning releases from the high profile retailers. Earnings for retailers like Target, Walmart, and Kohl's were surprise misses, and their forward guidance didn't really paint a pretty picture, which is given concerns about consumer spending. However, a lot of that weakness in earnings is really due to the bottom line and not the top line. If you dig deeper into those earnings releases and the financials for these retailers, you can see that retailers continue to deal with higher costs, such as shipping costs, as supply chains continue to be an issue. Wages are continuing to be high. Those costs are impacting earnings of these big retailers more so than weak sales. Margins have been cut in half. Demand has been okay, but costs have gone up. Meanwhile, inventory has piled up as consumers shift from buying goods to buying services, which has really caught many retailers off guard. And this is evidenced by the recent uptick in the inventory to sales ratio, which was at multi-year lows following the peak of the pandemic. Note, I really like watching that inventory to sales ratio during times of recession. That ratio spikes. It spiked during the Great Financial Crisis, spiked during the pandemic. And even though it's increased, it's still well below any of those periods of recession. In many retailers, they built up inventory due to the pandemic. The surprise retail misses are not as concerning when you consider the surprise misses are really more due to higher costs and not really consumer demand. The earnings releases by the retailers correspond to the release of inflation and consumer spending and savings data from the Bureau of Economic Analysis this week. The buildup of inventory is deflationary, and that retailers may have to cut prices to move the excess inventory. We saw that played out, and we also saw that play out in the April PCE figures as the Fed's preferred inflation figures started to roll over. Additionally, consumer spending continues to grow as it increased just under 1% in April, which also resulted in a steep decline in personal savings rate to 4.4%, which is the lowest since September 2008. So with all that being said, I think as investors or financial advisors, continue to prepare your portfolio or your client's portfolio for an economic slowdown. Despite the rolling over of some economic data, it is still too early to prepare for a recession or call a recession is going to happen in 2022, as I believe the consumer will continue to support the economy through 2022 and into the first part of 2023. However, I do believe the wealth effect will impact spending, consumer spending, when you consider the broad equity market is really a bad day or 2 bad days away from a bear market. The housing market is cooling and interest rates are rising. When you combine all those together, it's sure to make consumers rethink some purchases. And don't discount the impact the 50% decline in cryptocurrencies like Bitcoin will have on spending and how wealthy people feel. Moving forward, look for high quality dividend paying stocks with solid cash flow. Take advantage of the reduced valuations to add to positions. It is still too early, I think, to jump into the fixed income. Stay diversified, focus on your investment objectives. Don't go too big in the fixed income quite yet. And finally, look at the bigger picture. take a big view of markets, of your financial objectives, and really stick to your investment plan. All right, so segment number 1, staying sharp. So I like to look at the active versus passive argument periodically. I think it's very captivating, and it's very polarized, really, whether you like active management or you believe in passive management. So I recently wrote about this active versus passive debate again. And, you would think because volatility has picked up really since the pandemic, there was a little muted volatility after the pandemic. But, while it should benefit active managers, and it has, while passive managers have had their day in the sun over the past 10 years, active managers have really made a comeback. Like I said, after an extended time period, really between 2012 and 2019, equity volatility measured by the VIX index traded below its 20-year average of 19.5 for the majority of those 7 to 8 years. However, volatility has increased since the start of the pandemic. After a bout of low volatility in 2021, volatility has again surged above that 20-year average in 2022. So as we're all well aware of, heard about it a lot, and we're feeling it, the start of 2022 has been the worst start of equities since 1970, which has resulted in a spike in volatility. And active managers have really taken advantage of this spike in volatility. Over the past year, during the spike of volatility, nearly 75% of large and small value funds have outperformed their category index, while over roughly 50%, just over 50% of mid-cap value funds have beat the Russell Mid-Cap Value Index. Meanwhile, you flip that story, and that story is a little bit different on the opposite side of that style spectrum. Russell 1000 Growth Index has beat over 75% of active large growth funds, while the Russell Mid-Cap Growth Index has beat nearly 65% of active mid-cap growth funds. So while this 1 year time period has benefited active managers, particularly value managers and blend managers, we've seen an uptick in the number of managers who have outperformed their category benchmark. However, when you extend that time period and you look at 3, 5, and 10-year periods, which include the period of relatively muted volatility, where volatility or the VIX was well below its long-term average, that commentary changes. The percentage of active managers or active mutual funds who outperformed their respective category index falls across all equity styles, right? So, in closing, really, sure, your active manager may be down 10, 15, 20%, but hey, take solace in the fact that more and more active managers are at least beating their passive alternative. So Nauman's musing. So here we are, we're at a holiday weekend. So I'd really like to end this podcast with a special note that all of us at Zephyr remember and honor the sacrifices of those who gave their lives to protect our nation, its people, and our values. So with this Memorial Day weekend, let's remember all those who sacrificed their lives to protect our nation. Have a fantastic weekend, And I hope it's a safe holiday weekend as we kick off the summer season. Thank you. And with that, in closing, thank you all again for listening and watching. Be sure to like our YouTube and share our YouTube channel, Adjusted for Risk. Go to a wealth of insight from 6,237 feet website for additional insights and commentary from myself and happenings at Zephyr. Be sure to like and share that commentary as well. And with that, thank you, and we will see you next week.